morning, Kyle. Thank you for joining us today. Could you tell us a little bit about who you are and your background?
Good morning. Thanks for having me, Michelle. Yes, I'd love to. I am a technical investment manager, which means we use technicals and quantitative risk measures to position our clients' investments and try to make better investment opportunities, particularly based around avoiding bear markets. That's our biggest goal, and we use technical indicators in a tactical method to do so.
So that was going to lead me to my next question. Why technical over fundamental or some other way of looking at the market? What was it about technical?
Well, I like things pretty cut and dry. I like systematic processes and using a technical approach that really allows us to be able to build, test, evolve on different ideas. I come up with all sorts of different ideas and just general thoughts around ways to better manage risk, and using technicals allows me to really test that method first and foremost and feel confident in the approach before just going about and testing it with real money. It allows me to back test and do simulations that really get me comfortable with a method. And so that's what I really like about it. Is it's systematic. You can test it. You can build confidence, and then you can always build on top of it and evolve off of certain processes.
Got it. That makes a lot of sense. It sounds really intriguing. But are technicals ever wrong?
Yeah, absolutely. It's a probabilities game. We build risk-reward models based on probabilities. Really high probability models get the most attention, and we drive most of our assets towards the strongest risk-reward scenarios, with the first focus on avoiding bear markets. If we can avoid bear markets, all of a sudden making money on the upside becomes much easier to do. So as long as we keep our focus on avoiding bear markets and raising cash to do so, or creating other hedges, it creates a strong, repeatable process for going forward and going through all sorts of different market cycles.
I understand. And your key about really avoiding a bear market is where I'm going to go next. As people look at the economy and the market today, what I feel, and I think a lot of others do, is there's a lot of uncertainty in terms of what COVID-19 has brought on not just the United States, but the globe. We know a lot of economists are not able to comfortably predict any future outcomes, yet our stock market is high, which seems to be almost a disconnect. We don't know if, when we come through this, if fear is going to keep people not moving and fixing the economy, or if people are going to resume as normal. So it seems like an unlikely time to enter the market. What made you want to go in?
Yeah, it certainly is. Sometimes when you get buy signals, they don't always feel good because it can be clouded by a lot of uncertainty. But as I mentioned, using systematic processes cuts through that. It cuts through the emotion. And so we had our core technical indicators created a bullish or positive signal on the overall market, meaning the majority of stocks in the market are now in bullish trends, which creates momentum and support for the market to continue higher. But just like we said before, it's always about probabilities. There's not a guarantee that it's going to continue higher. We look at a variety of different indicators and patterns within the market, and most of them are pointing upward and positive. But there's certainly plenty of uncertainty, and the market can be driven by sentiment, even when fundamentals or technicals look good. So things can certainly turn around, but we put the probabilities in our favor by using the indicators that drive this bullish or positive signal. And so we get that positive signal. We enter. We can take it off. The nice thing is that there is a bit of a backstop. There wouldn't need to be a 15-20% correction in the market for us to raise cash, because we are just on the cusp of positive. That allows a bit of support should things turn around. We just get out. We're not investing for 1 day, 5 days. We're looking for 2 to 6 month types of trends that we can take advantage of. And so if we get a turnaround, if this market turns back down, we'll raise cash again. There's no problem with that.
Got it. And to show us this and really go into a little more detail, you prepared a presentation for us.
I thought I'd throw together a couple of slides and show just a couple of charts that puts the picture to this. Why don't I pull that up?
Okay, great. Perfect. There we go.
The first and one that you'll hear about is this is the S&P 500 over the last year with that white line going through it is a 200-day moving average. Now, it's a really basic way. This isn't our indicator. This isn't what generated a buy signal. I think it's interesting just to see what other types of technical indicators or factors correlate when we get buy signals as well. And one that most recently happened is the S&P 500 got above its 200-day moving average. And when that happens is usually bullish in general, but particularly in this most recent correction and the scenario, when we have an event where the S&P gets more than 20% below that 200-day moving average, as you can see here, it dropped 26% below the 200-day moving average. The overall correction was about 34 or 5%. But in this event, when the S&P gets more than 20% below its 200-day moving average and then recovers above its 200-day moving average, that historically has been very, very bullish. And that's going all the way back to the Great Depression and the OPEC oil crisis in the 70s and 2008, 2009. So this is just one thing. This isn't what generated the buy signal, but I thought it's interesting to look at because you will hear some simple technical analysis done on different newscasts or different publications will mention this type of thing. It's pretty basic. I wouldn't look at this and go, this is a definitive buy signal, but when it's alongside our core indicators also producing buy signals, I think it just strengthens the likelihood for a good result.
Terrific.
Now the next, this is also the S&P 500 on the behind in the blue, but this is actually one of our core indicators. It measures the overall breadth of the market, meaning instead of simply looking at the S&P 500 and the price of the S&P 500, we actually go underneath the S&P 500. We look at those 500 components, and then we measure trends within those individual components. And what we found is that that's more effective at identifying stronger trends and measuring higher probability scenarios for success. And so what we have here is this red and green line. That's one of our indicators. And basically, when it gets above 50, that is a buy signal. And so there's a couple other things that have to go along with it. But as you can see, it just got above 50, above that 50 level, meaning 50%, more than 50% of stocks are in bullish patterns. Meaning the majority of the market is now trending higher. And so that's really positive. We actually break this down into multiple different indices, and as well as the overall market. We'll look at small caps, mid caps, as well as technology stocks. But so this was the real driver. When it peaked above 50, that's a big positive sign for the overall market, especially when it got down to such depleted levels. For it to come back this far is really, really positive.
So before you move, can you go back a shot? I have
Sure.
two questions that I wanted to ask. So I noticed that probably just before the beginning of March 2020, there's that slight area where the breadth seemed to be moving up, and you had a very touch of green, and it was also over your 50-day moving average. What makes that different? It didn't last, obviously, to what we're seeing now. How do you look at those differently?
Well, that's actually that's an interesting time to point out. I'm glad you did. We had most people don't even really remember, but the initial concerns around the coronavirus occurred in the, are you able to see my mouse?
Yes, absolutely. Thank
It
you.
actually occurred right in this area, kind of in February. And then the market continued back higher and took out its recent highs. However, one item that we took into consideration, so we had raised cash right in this area. And so we had over more than 50% cash on hand. And then going into this, as the S&P 500 recouped that initial concern and made new highs, our indicator was continuing lower. That's a big divergence from the market. That's a big warning sign. And so as the market made new highs, we kept that cash on hand. Now, I'm not saying we were going to predict a 35% sell-off in a month and a half, but that is a warning sign when you see breadth deteriorating and the majority of stocks are actually starting to move down as the index is moving up. That's a warning sign. And so we kept a large chunk of cash as the market was going up. And then obviously that did us well once the sell-off started taking off. And then as it crossed below 50, we raised more cash.
Got it. Okay. Go ahead.
Now looking at the big question is are we in a bear market? Is that this is, as I mentioned, this is our main concern. So I really do a lot of analysis around what bear markets look like. They actually tend to play out in a pretty particular pattern. And this is going back in all as far back as you can think, back to the Great Depression, and again in the 70s, and as well as in the .com in 2008. And what we're really looking for on the bear market patterns is that this red and green line going through there is a 20-month moving average. So basically, it just takes the average closing price of the S&P 500 over the last 20 months. And what we found in bear markets is that it's very difficult for the market to have a sell-off and then come back up above that 20-month moving average. And so, as you can see, most recently, we did break above that 20-month moving average. So that is very positive for the overall market. If you look back in 2008, 2009, as well as in the .com bubble, you can see it did not get back above there. And those are only two instances. So if we actually take a look further back, go back to the 1960s, there were 1, 2, 3, 4, 5, 6, 7 other occurrences where the bottom had been in place by the time that it came back above that 20-month moving average. So that basically, if you look at history, it's a really positive sign for the market to be back above that moving average. It's pretty simplistic in nature, but it's how bear markets tend to play out, and so it's really worth paying attention to.
Got it. Understood. Are you saying then, from the way you read this, that we might be out of that? That was a bottom.
Yeah, we might, but this was a really unique sell-off in the market because we've never had such a strong sell-off from a market high, 35% correction coming in from a high and only taking a month and a half to occur. That's really unique. So we are kind of in our uncharted territory, but these type of technical indicators are still really effective and worthwhile. It helps cut out all the emotion. So I'm not saying that it can't go back down below this and enter a bear market, but at this point, there's a lot more positives than there are negatives when looking at the technicals of the market.
It could potentially hover up and down in this sort of channel going forward.
Certainly. Yeah, certainly. We may not get back to, if things do continue to recover, Yeah, it could take a while. It could take the rest of the year before we get back up there. Summer months tend to be more volatile. So as we're entering June, July, August, those can be somewhat challenging for markets, especially as we come out of this condition. But we'll have to see how it goes. I don't forecast. I look at what the data tells us, and find out what the probabilities of these different scenarios are, and just try to use those to our favor. And this is one that is positive towards a more bullish outlook.
Got it. Thank you.
One question that that many of our clients frequently ask is, gosh, there's so much bad economic data out there. And probably the biggest economic data point is the unemployment rate that recently just spiked to about 15%. And people say, well, if the economy is crashing, why is the market going up? And so it's important to remember that the stock market is anticipatory. So it's looking 6-12 months out. It overreacts to news. So there's always an initial reaction based off potential fear, even though it's not showing up in the actual economic data yet. And so that's what we really saw was the initial sell-off from COVID-19, driven simply by fear more than anything. It was really just around the unknown. And then sure enough, this economic data came out. And so I would expect bad economic data for the next couple of quarters. And then hopefully as things open back up, we'll see some sort of rebound in the fourth quarter. But with that, you have an unemployment rate at such a high level. It's one thing that you may frequently hear is don't fight the Fed.
Yeah.
And the Fed essentially implemented QE infinity, which means they just have unlimited buying potential to support the overall economy and the market. And so they're doing things that they've never done before, even buying corporate bonds, high yield bond funds, ETFs, which is something the Fed's never done before. So as you can see, their balance sheet is expanding with no real plan to significantly reduce that anytime soon. So as long as they are supporting it, it could be, this does create a level of artificial inflation, but it's hard. You can't go against it, and the market is reacting to that. Excuse me. And those are basically the charts that I wanted to show. I think it's just important to take things one day at a time, keep the big picture in perspective. Even though we got invested, I wouldn't be surprised to see some level of volatility. It's natural within the summer months. And I think there's, we'll take it one day at a time and just see how things go. But if things were to turn around, we have the flexibility to raise cash again and get more defensive if necessary. But we'll wait for those signs to arise before we do so.
Thank you, Kyle. That was really a great explanation, kind of giving us an idea of where you are. I'm definitely going to have you come back again and share with us what's happened as a result of this.
Yeah, thank you so much for having me. I appreciate it. It's great to be with you.